So we go to account. We are rounding up chapter 1 in accounting. So today we want to talk about the role of auditors. The auditors. Who are the auditors? Auditors are people they are professionals. They examine the financial statement of a company. They examine the financial. That means the financial statement of the company would have been produced or would have been presented. Then they examine it if it represents a true and fair situation. Because whatever your financial statement is, whatever information you've put together, it must reflect in the financial position of your business. So your trading profit loss account, whatever you have there, must reflect in your financial position. So whatever you are telling us that this is what your company is, it has to be what it is in the book. That is why we have auditors. So that's what they do. They examine it. So I'm going to read further anyway. I wrote, the auditor is a financial professional who examines the company's financial records, statements, and process to ensure they are accurate, transparent, and compliant with laws and standards. And when we talk about laws and standards, we're talking about the International Accounting Standard, IAS. So they want to be sure that you complied, the business or the company has complied with every details that is needed to present or to produce that financial statement. So we have two types of auditors. We have the internal auditors and the external auditors. For internal auditors, they are auditors that are they are employees of the company. So what they do is they monitor the control process. They want to be sure that workers are doing the right thing. That is what they do. They monitor the control process. But as soon as they monitor the control process, that is where it ends. Then we have the external auditors who are in the independent organizations. They are professionals too. They only come in to examine what the company has presented before it's finally presented to the stakeholders. So I'm going to read further anyway. For internal auditors, I wrote, they are employed by the company, they audit. They provide objective evaluation of a company's internal control. So they just want to be sure that the control system is in place. Because whatever an organization do, whatever you do, it has to be compliant with the law of the company so that the company can achieve its goals. You get internal auditors here. Then we have the external auditors. These auditors work for independent accounting firms and are hired by client companies to perform audits. That is what they do. They examine. They are being hired to examine the financial statement of a company. So they provide assurance to shareholders and other stakeholders that the financial statement of the company is accurate. So without external auditors, we wouldn't know if the financial statements you are presenting to us are correct or not, because stakeholders do not have, they don't have deep information about items in the financial statement. So the only people they could trust are the external auditors. So they have the external auditors to provide them with their own opinion about the financial statement. Do you get it? Any question about internal and external auditors? Any question, please? No. Okay. So go to the true and fair now. We go to true and fair. That is the main reason why we have to audit the financial statement. And when we talk about true and fair here, it simply means at the end of the audit, the financial statements must present fairly the financial position, which is the worth of the business presently, the financial performance, how they are able to reach that position, and the cash flows of the business. We get to know this through the trading profit loss accounts. So at the end of the audit, this must be presented. This must clearly state the reports on the audit. So, however, if the auditors feel that the records and statements do not represent a true and fair view, they will issue a qualified opinion in their reports. This may raise issues in those areas where the records have not been maintained properly. This may also hinder the external source of finance for the company. Now, let's go back to qualified opinion. The auditors are to check and balance things. So if they figured out that the statement provided does not represent a true and fair view of the financial position, then they give their own qualified opinion about it. Do you have any question about that? No. Okay, then that takes us to the other roles of auditors. One, to provide independent opinion on whether the financial statement comply with international accounting standard. Okay. So they have to give opinion on this. To state whether the financial statement to state whether the financial statement have been prepared on the basis of the business being a going concern or not a going concern. What does a going concern mean? Going concern, what does it mean?
Ongoing concern, like it's like happening every time, or
No.
a concern every time.
No. Going concern is an accounting concept that states that the business must be run as if it will never end.
Okay.
So are you preparing the financial statement because you want to shut down your organization and distribute the money and that's all? Or you are preparing the statement or the financial statement in a way that it represents what happens in the future.
Okay.
So if it represents what happened in the future, then that is a going concern. But if it's representing the end, closure, then it is what? It is not a going concern.
Okay.
So the auditors must provide us with that information to know if the company is still reliable or the company is shutting down. The third one, to test the financial recording procedures and control system in place by the company to minimize the risk of fraud. So they want to check the internal auditors because the internal auditors would have checked the control system. Then if the internal auditors are not doing it right, the external auditors will expose them. And why do they have to do this? They have to do this to minimize the risk of fraud.
Okay.
And the last one
is to
ensure that the director's report is included with the published financial statement. We have what we call the director's report. We're going to talk about that. So the director's reports are this financial statement that has been provided, information about the company, the business activity. It has to be attached to the financial statement. Any question about rules of auditors? Any question? No. So it goes to corporate governance and the auditor's reports. I'll go right back.
Sarah, did you?
We'll go to corporate governance. When we talk about corporate governance, it's all about the systems and procedures which a business or a company use in terms of its controls and direction. A company needs corporate governance because without a corporate governance, you cannot focus on the interest of stakeholders.
Yes.
The focus is to take care of the interests of stakeholders and not the shareholders. And for that to happen, you need corporate governance. And that's why corporate governance is what? It outlines the system and procedures by which companies are controlled and directed. So the focus about corporate governance is that companies should focus or look after stakeholders rather than shareholders, which simply means that companies should be socially responsible.
Yes.
Do you understand corporate governance here? It's a system, but the system is just telling us that we should think about stakeholders rather than shareholders.
Okay.
Is it clear?
Yes.
So that takes us to the auditor's report. Are you there?
Yes.
For the auditor's report, so here I'm going to read further then. Okay. The auditor's report consists of three main sections. The first one is it consists of three main sections. The first one is the separate responsibilities of the directors and the auditors. So what are the responsibilities of the directors? What are the responsibilities of the auditors? The directors provide a financial statement. The auditors examine the financial statement. Do you understand the first one? When they examine, it doesn't end there. They give their own opinion.
Okay.
Hold on, please. I'm not done with it. Just see here. So the auditor's report, like I said earlier, the first one, the separate responsibility of the directors and the auditors. What is the responsibility of the director? To prepare the financial statement.
Okay.
And for the auditors, they examine the financial statement and give their own opinion about the financial statement. The second one, the basis of the audit, the details about the audit. Why is it carried out?
Okay.
That's the second section. And the third section is the opinion. That is the overall assessment of the financial statement.
Perfect.
So these are the three auditors' reports in this section. The separate responsibilities of the auditors and the director, which is auditor to examine, director to prepare. The basis of the audit, why are we auditing?
Yes.
The details about it, why is it being carried out? And the opinion, the overall assessment of the auditor. Any question about the auditor's report? Good. Now go to the director's reports. Are you there?
Yes.
I'll be right back. Yes. Now that we've done the auditor's report, now we think about the director's report. Remember, the director is the one in charge of presenting the financial statements
Yes.
to the auditors. So this report is a summary of the main activities that have happened during the year and details changes in those activities. So for the director's report, the director is in charge of the organization. So whatever has happened during the year, everything is part of the director's report, which will be attached to the auditor's report.
Okay.
So what are the items in the director's report? The first one, the review of the past year's activities. What happens the last year? The details, the review, or your summary about the events of the last financial year. The position of the year end. Where are we presently? A summary of future trading prospects. So what is there for us to gain in the future? Oh, even you have to talk about your accrued, your prepayments in the future. Everything has to be stated there. And what is it there? What is the market opportunity out there for you as a business? Because these things has to be attached to the auditor's report, which will be presented to mostly the shareholders. And the next one, significant changes to non-current assets. When we talk about non-current assets, we're talking about non-physical assets like goodwill, patents, trademark.
Yeah.
What else do we have there? Copyright and the rest. So all these are non-current assets, but they had value to the organization. And the last one, recommendations for dividends for the current year. So the director would, recommend the amount of dividends that should be given to shareholders. Any question about that? That's about the director's report. It's different from the auditor's report. The auditor's report will state the directors, the different responsibility of the directors and the auditors. It will state the basis for carrying out the audit and the assessment of the audit.
Perfect.
That is for auditor's reports. But for director's reports, it will be attached to the auditor's reports. But the last thing in the director's report is the recommendation for dividends of shareholders, because they have to pay shareholders dividend. Any question about that? So that takes us to continuing and discontinued activities. When we talk about continued activities, we're simply talking about the future, going concern. So, the business will continue even after now. The future of the business, that is continuing. So yeah, I would continue operations that refer to activities that the company expects to be engaged in for the future. Our prospects, what we are expected to do over the year, that is continuing operation. That means the organization doesn't end. That means the business, the company is a going concern.
Yes.
But if it is discontinued operation, it means we're talking about those activities that the business has stopped or has sold or has disposed of.
Yes.
So yeah, I would discontinued operation refer to the activities that have been stopped. Stopped means we end it.
Yeah.
Being sold, you sold it. Maybe by or maybe through acquisition. Disposed of. So if this happens, if any of these items I mentioned happened or situation happened, it means there's a discontinued operation. Is that clear?
Yes.
And that takes us to exceptional items.
Special items.
Exceptional items.
This part.
Yeah.
Okay.
So we're going to exceptional items. Why do we call them exceptional items? These are items that they possess a significant gain or loss in the organization, but they are not things that we always see over time. So they are recorded separately from the income statement. They are reported separately. But these things, they are huge. The effects will be felt within the organization. That's why we call them exceptional items. So I'm going to read further. These are significant gains or losses from events or transactions that fall within a company's ordinary course of business, but are infrequent and material in size. It's not like something that you see constantly, but they are material, they are huge. The impact will be felt within the organization. So it means as a director, you have to report it.
Okay.
So they are reported separately on an income statement to provide investors with a clearer picture of the company's normal operating performance. So you report it separately so that they can understand. So The owners of the business that have put money into the business would understand where their money is going and how the business is performing over time. So what are the examples of exceptional items? The first one here I wrote is restructuring cost. Restructuring cost. Oh, now we have new management board. Oh, we are changing our managers. We're doing this. We're doing that. These things are cost incurred, and they are significant because money will be spent upon them on them. So you have to report this. The second, although they didn't give examples here, but I think I know the examples already. Two, gains or losses from the sale of a large asset. Oh, the business has a premises or a facility outside the organization and it's going to sell it. So when you are selling such a huge asset, it has to be reported. The third one I wrote is litigation settlement. When we talk about litigation settlement, we're talking about maybe you have a court case. Litigation means court procedures. So, or maybe a client has sued you and you have to pay damage.
Yeah.
Or probably in the course of, yes, you have to pay damage. Maybe on breach of contract. That's a huge amount of money. It has to be reported. They are still part of exceptional items. They don't happen every now and then, but they could happen once. And when they happen, it has impacts on the financial statement of the business. And the last one I wrote is about asset impairments. When you talk about asset impairment, we're talking about a situation whereby the book value of an asset is higher than the marketable value. Oh, this asset was 5,000 in the book value, the NBF, the net book value. But in the market now, we're going to sell it less than that. That is what we call asset impairment. So I wrote here, the value of asset has declined over time, which means the book value exceeds the recoverable amounts. Any question about it? Good.